FIRE, financial independence, retire early. For a decade, it wasn't just a financial strategy, it was a cultural phenomenon, a modern-day declaration of independence. It was the dream blueprint for escaping the 9-to-5, a promise whispered in podcasts and shouted from blog posts. The formula seemed so elegantly simple, so achievable. You just had to live differently. Reject consumerism, slash your expenses with ruthless efficiency, and funnel every spare dollar, 50, 60, even 70% of your income, into low-cost index funds. The mantra was, Veets Sachs and chill. The math was backed by the revered Trinity study and its famous 4% rule, which promised that a carefully managed nest egg could last indefinitely. The goal wasn't just to stop working, it was to reclaim your life, to trade in your soul-crushing commute for a life of passion projects, world travel, and the priceless commodity of time. It was a movement built on the bedrock of a specific economic climate, a long, roaring bull market, historically low inflation, and rock-bottom interest rates. It was a golden age for aspiring early retirees. But it's 2025 now, and the world that birthed the FIRE movement is a distant memory. The rules haven't just changed, they've been completely rewritten. The economic tailwinds that propelled a generation toward early retirement have reversed into powerful headwinds. The primary culprit is a word that was almost forgotten in the 2010s inflation. After the global economic shocks of the early 2020s, persistent, stubborn inflation has become the new normal. According to the Bureau of Labor Statistics, the cumulative inflation since 2020 has effectively acted as a wealth tax on savers. A nest egg of $1 million meticulously saved by the end of 2019 has lost over 20% of its purchasing power. That's $200,000 of your retirement vanished into thin air, not by a market crash, but by the rising cost of simply living. This isn't just an abstract number, it's a daily reality. It's the price of gasoline that makes you rethink a weekend trip. It's the grocery bill that has doubled for the same cart of food. And most critically for the FIRE calculus, it's housing. The Case-Shiller Home Price Index shows a meteoric rise in property values, pushing the dream of owning a home, let alone house hacking your way to financial freedom, out of reach for many. Renters are facing similar pressures with annual increases that devour savings. To combat this inflationary fire, central banks, led by the Federal Reserve, unleashed their most potent weapon, higher interest rates. The era of cheap money is definitively over. While this was a necessary evil to cool the economy, it has shaken the very foundations of the FIRE movement's investment strategy. The stock market, no longer fueled by near-zero interest rates, has entered a period of intense volatility. The brutal bear market of 2022 was a wake-up call, a painful lesson in sequence of returns risk for those on the cusp of retirement. Suddenly, VT Sachs and chill felt less like a surefire strategy and more like a white-knuckle ride. The psychological toll has been immense. The finish line, once so clear and tangible, is now perpetually moving further away. The FIRE number you calculated in 2019 is now woefully inadequate. For many, this has led to a crisis of faith. Was the dream a lie? Was all that sacrifice for nothing? So, what's still working? What's outdated? And how do you adapt your FIRE plan to survive and thrive in 2025? We have to start by stress testing the old playbook. The first pillar to crumble under scrutiny is the sacred 4% rule. Conceived by financial advisor Bill Bengen in 1994, the rule was based on a specific set of historical data from the U.S. market, assuming a 50/50ths to 75/25ths stock-bond portfolio. But today's leading financial minds from Wade Pfau to Michael Kitces are sounding the alarm. Their research, based on current market valuations and lower expected future returns, suggests that a truly safe withdrawal rate for a 30-year retirement might be closer to 3.5% or even lower. For a $1 million portfolio, that's the difference between a $40,000 annual income and a $35,000 one, a massive lifestyle change. The old rule simply doesn't account for today's economic realities. Furthermore, the once popular lean FIRE strategy, retiring on a bare-bones budget of, say, $30,000 a year, has become incredibly precarious. When your budget has no fat to trim, a sustained 5% inflation rate isn't an inconvenience, it's a catastrophe. It means choosing between paying for healthcare and paying for food. The margin for error has evaporated. The FIRE movement, which exploded in the optimistic 2010s, is now facing a sobering reckoning in 2025. we're dealing with a toxic cocktail of persistent inflation and unpredictable market volatility. The impact is stark. Credible analyses suggest that to achieve the same inflation-adjusted lifestyle, U.S. households now need 30 to 40% more in savings than they did just 5 years ago to hit the same lean FIRE budget. That means a goal of $1 million has effectively become $1.4 million. For someone who was just years away from their goal, this is a devastating setback. It feels like the game is rigged, that the dream of financial freedom is slipping away. But to declare FIRE dead would be a mistake. To believe that the principles of saving, investing, and intentional living are now worthless would be to miss the bigger picture. Because within every crisis lies opportunity. The very forces that have shattered the old paradigm are forging a new one. The FIRE movement isn't dead, it's evolving. It's becoming smarter, more resilient, and more adaptable. And here's the catch that changes everything. Opportunity still exists, and in some ways it's more potent than ever. The same high interest rates that punished the stock market have given new life to a long-forgotten asset class. For the first time in over 15 years, cash and bonds are no longer trash. With high-yield savings accounts and government bonds offering yields north of 5%, there is now a powerful tool to generate stable, low-risk income and de-risk your portfolio. The old mantra of "there is no alternative to stocks" is dead. At the same time, a technological revolution is creating entirely new avenues for income generation. The rise of accessible AI isn't just a headline, it's a practical tool for building side hustles, automating tasks to increase your savings rate, and creating businesses with minimal capital. Finally, the pandemic-driven shift to remote work has supercharged the concept of geographic arbitrage. You no longer have to be chained to a high cost of living city. The freedom to earn a big city salary while living in a low-cost area, or even obtaining a digital nomad visa to live abroad, is a financial cheat code that can slash years off your FIRE timeline. The game has changed, but it's far from over. The path to financial independence in 2025 requires a new map, new strategies, and a new mindset. And in this series, we're going to draw that map for you. The FIRE movement, financial independence, retire early, promises a life of freedom, unshackled from the 9 to 5. But the economic landscape has evolved. The strategies that worked for the pioneers a decade ago don't always hold up to the pressures of the 2020s. So how do we navigate this new terrain? The key is to separate the timeless principles from the outdated tactics. Let's dive into what still works, what absolutely doesn't, and how you can adapt your strategy to build a resilient path to financial freedom today. Let's start with the bedrock of FIRE, investing. The good news is that the most powerful strategy for wealth creation remains intact. Index fund investing still compounds wealth over time. The principle is simple. Instead of picking stocks, you buy the entire market through a low-cost index fund, giving you instant diversification and dramatically lower fees. Consider this: a $100,000 investment in an S&P 500 index fund at the start of 2015 would be worth around $320,000 by early 2024, despite weathering the COVID-19 drop and other volatile periods. This is the power of compounding and time in the market. As Warren Buffett advised, for most people, the best thing to do is own the S&P 500 index fund. Data from sources like Morningstar consistently show that most active fund managers fail to outperform their benchmark index, charging higher fees for worse results. The takeaway is clear. The core engine of wealth accumulation for FIRE hasn't stalled. The formula is simple: save aggressively and consistently invest in low-cost, diversified index funds. Don't time the market, just keep buying. Next, a strategy that supercharges the retire early equation, geo-arbitrage. This concept works brilliantly. It's the art of earning in a strong currency, like the US dollar, and spending in a country with a lower cost of living. This can drastically shorten your timeline to FIRE or increase your quality of life in retirement. We're seeing a wave of retirees leveraging this. Take Portugal, with its beautiful coastlines and affordable healthcare. A monthly budget of $2,500 there can afford a lifestyle requiring $6,000 in a major US city. Then there's Mexico, a favorite for its proximity to the US and incredible value. Expats there can afford luxuries like a housekeeper and quality private healthcare on a modest budget. And we can't forget Southeast Asia, particularly Thailand. Its low cost of living allows a nest egg to stretch for decades longer. However, geo-arbitrage isn't a vacation. You must navigate complex visas, plan for healthcare, and handle cultural adjustments. The emotional toll of being far from family is also real. The key is meticulous research. Use resources like Nomad List for cost comparisons, join expat forums for first-hand experiences, and take a long scouting trip before making the leap. Now we pivot to strategies cracking under pressure. The biggest is the 4% rule. For many in the FIRE community, especially those planning for very long retirements, this rule is broken. It originated in 1994, when a study found a retiree could withdraw 4% of their portfolio, adjusted for inflation, and have it last 30 years. But the key is 30 years. FIRE is about retiring at 40, meaning your portfolio must last 50 or 60 years. This dramatically increases the risk. Furthermore, the study used historical U.S. market returns. Today, many experts project lower future returns for stocks and bonds. With slower growth, withdrawing 4% eats away at principal much faster. This highlights the biggest threat for early retirees: sequence of returns risk. If a bear market hits in your first few years, withdrawing a fixed 4% from a depleted portfolio can be catastrophic, as you're selling more shares when they are cheap, impairing recovery. So, what's the new number? In 2025 and beyond, experts suggest a more conservative withdrawal rate between 3% and 3.3%. It might mean working a few more years, but it dramatically increases the odds your money will outlive you. The alternative is a flexible withdrawal strategy, like using guardrails to reduce spending in down markets. The rigid 4% rule is a relic. Finally, let's dismantle two other outdated assumptions: career stability and the infallibility of real estate. The idea of a one-job retirement is a fantasy now. Likewise, the belief that real estate is a guaranteed passive path to riches has been crushed by market realities. Job stability has weakened. We've seen massive layoffs, even in safe industries. The rise of AI and the gig economy means skills can quickly become obsolete. For someone in the accumulation phase of FIRE, this unpredictability is a major threat. The modern strategy requires multiple income streams, lifelong learning, and a robust emergency fund. Simultaneously, the easy button of real estate investing is gone. For years, house hacking was a FIRE cheat code. While it can still work, the barrier to entry is immense. Property costs have skyrocketed and mortgage rates have surged, crushing cash flow models. Being a landlord is also far from passive, involving difficult tenants, unexpected repairs, and rising taxes and insurance. Real estate can be a powerful part of a portfolio, but it is not the guaranteed low-effort path to wealth it was once portrayed to be. So where does this leave us? The dream of financial independence is not dead, but it demands a more realistic approach. The foundational principles, living below your means, a high savings rate, and leveraging compound growth through low-cost index funds, are more important than ever. But we must discard outdated dogmas. We must be more conservative in our withdrawal plans, more resilient in our careers, and more critical in our assessments. The new FIRE is about flexibility, adaptability, and a clear-eyed view of the modern economic world. As we navigate the financial landscape of 2025, the traditional all-or-nothing model of financial independence, retire early, is evolving. The rigid path of extreme saving followed by an abrupt stop to all work is giving way to more flexible, resilient, and frankly, more realistic strategies. The pursuit of FIRE is no longer just about escaping the workforce, it's about designing a life with more freedom, purpose, and security. The core principles of saving and investing remain, but the application has become far more nuanced. Today's successful FIRE adherents are adapting, blending old wisdom with new opportunities to create a financial future that can withstand economic uncertainty and align more closely with their personal vision of a well-lived life. The first, and perhaps most significant adaptation is the widespread embrace of a hybrid model, where the line between working and retirement becomes beautifully blurred. This is the new paradigm of semi-retirement, often called barista FIRE or hybrid FIRE. It's a strategic choice to continue working, but on your own terms, part-time in a passion field or as a consultant. This approach provides a crucial financial buffer, reducing the pressure on your investment portfolio, especially during volatile market periods. Consider the real-world case of Mark and Susan, a couple in their early 60s living in Arizona. Their original plan was a conventional retirement at 65. However, after the market turbulence of recent years and rising healthcare premiums, they pivoted. Today, they embody the hybrid FIRE model. Their investment portfolio, carefully built over 3 decades, now covers approximately 70% of their annual living expenses. The remaining 30% is comfortably covered by Mark's part-time consulting work in his former field of logistics, which he does for just 10 hours a week entirely remotely. This $25,000 a year not only bridges the financial gap but, as Mark reports, keeps him mentally sharp and socially connected. This strategy significantly lowers their portfolio withdrawal rate, protecting their nest egg for the long term and allowing it to continue growing. This trend is supported by data from the Employee Benefit Research Institute, which notes a growing preference for phased or partial retirement, citing not just financial necessity, but the psychological benefits of maintaining a sense of purpose and routine. The second major adaptation is the intelligent use of technology to create new, scalable income streams. Artificial intelligence is no longer science fiction, it's a practical tool for generating significant side income. Ambitious individuals are leveraging AI to build businesses that are not directly tied to their time. For instance, the idea of selling a digital product is more powerful than ever. Imagine creating a comprehensive digital guide, perhaps on a niche hobby, a professional skill, or even navigating a complex video game. You create it once. Using AI tools to help with research, writing, and design can slash the creation time from weeks to days. Then you set up an automated sales funnel online. The original example of selling a $49 guide 200 times a month isn't a small goal. It translates to an incredible $9,800 per month, or over $117,000 a year. While that's a high bar, the principle of scalability is what matters. Even selling just 20 copies a month provides nearly $1,000 in passive income. Other AI-driven hustles include offering AI-powered content creation for small businesses, generating unique art for print-on-demand merchandise, or building custom AI chatbots for companies. These ventures allow you to build an income engine that works for you 24/7, a cornerstone of the modern FIRE strategy. On the other side of the income coin is the preservation and safe growth of capital. For the first time in nearly 2 decades, high interest rates have made conservative investments incredibly attractive. While stocks are essential for long-term growth, the current environment allows for a powerful defensive play. With yields on U.S. Treasury bonds hovering around 4 to 5%, investors can now generate substantial, virtually risk-free income. This is a game-changer for those in or nearing retirement. This stable income from treasuries or high-yield savings accounts can cover a significant portion of living expenses. This means that during a stock market downturn, you aren't forced to sell your equity assets at a loss to pay your bills, a phenomenon known as sequence of returns risk, which can devastate a retirement portfolio. By building a bond ladder or simply holding funds in a high-yield account, you create a reliable cash flow that acts as a safety net, allowing your stock portfolio the time it needs to recover and grow. This balanced approach, pairing high-tech, scalable side hustles with low-risk, stable investment income, is a hallmark of the resilient 2025 FIRE strategy. Finally, the modern FIRE movement champions personalization, recognizing that there are many paths to financial freedom. 2 specific strategies, Coast FIRE and geo-arbitrage, have gained immense popularity. Coast FIRE is a strategy for reducing stress mid-career. The concept is simple. You save and invest aggressively early on until you reach a point where your existing nest egg, without any further contributions, will grow to your full retirement number by age 65. Once you hit your Coast FIRE number, you no longer need to save for retirement. You only need to work enough to cover your current living expenses. Let's take Sarah, a 42-year-old graphic designer. Her FIRE number is $2 million. Through diligent saving, she has already amassed $600,000 in her retirement accounts. Assuming a conservative 7% average annual return, that $600,000 will grow to over $2 million by the time she's 62, without her saving another dollar. So, Sarah has coasted. She quit her high-stress agency job and now works 25 hours a week as a freelancer, earning just enough to pay her bills. She has reclaimed her time and mental health, all while her retirement quietly secures itself in the background. Then there's geo-arbitrage, the strategy of earning in a strong currency, like the US dollar, while living in a lower-cost country. Consider a digital nomad couple living in Lisbon, Portugal. They earn a combined remote income of $80,000 a year from US companies. In a city like Austin, Texas, that income would feel tight. But in Lisbon, they live an incredibly high-quality life for about $3,200 a month. They enjoy a beautiful apartment, eat out regularly, and travel throughout Europe. The crucial part? They are still able to save and invest over $3,000 a month back into their U.S. investment accounts, dramatically accelerating their path to full financial independence. These strategies, hybrid FIRE, tech-driven income, safe yields, coast FIRE, and geo-arbitrage, are the tools of a new generation. They represent a shift from a rigid singular goal to a flexible, adaptable journey toward a life of financial resilience and personal freedom. FIRE isn't dead in 2025, it's evolving. Forget rigid formulas. Think flexible, adaptive, and diversified. The new FIRE isn't about escaping work entirely, it's about building financial independence on your own terms.